Living alone in America brings a distinct sense of peace and independence. You control the space, the schedule, and every decision made within these walls. However, this autonomy relies on a singular point of failure. In a single-income household, there is no secondary earner to absorb the impact when life stops going according to plan. Bankrate's 2026 data reveals that fewer than half of all Americans have the liquidity to cover a standard $1,000 emergency expense. For nearly 30% of the country, credit card debt has actually surpassed their total emergency savings. Without a dedicated cash buffer, the stability of independent living is fragile. A single surprise bill can quickly trigger a cycle of high-interest debt that takes years to resolve. Financial analysts call these events cash flow shocks. These are the sudden, non-negotiable disruptions to a perfectly managed monthly budget. In the United States, car ownership is a primary source of these shocks. The hidden costs of maintenance, fuel, and taxes now average nearly $7,000 per year. The average car repair bill has reached $838. On a single income, an invoice of this size can instantly exhaust a checking account. Healthcare presents a similar risk. A routine visit for an urgent care issue can result in a high-deductible bill that requires immediate payment before insurance coverage begins. These expenses are statistical certainties of American life. Relying on credit cards to bridge these gaps transforms a temporary logistical hurdle into a lasting financial burden. To build an effective defense, you have to determine exactly what it costs to maintain your household for a single month. We start with data from the Bureau of Labor Statistics, which provides the objective baseline for single-person expenditures in the U.S. This data shows the average single person in America spends roughly $4,641 per month to cover living costs. Housing is the largest non-negotiable expense, averaging $1,684 monthly. Transportation adds another $756, and healthcare averages $367. These essentials consume the vast majority of a single income before discretionary spending even begins. Identifying your personal monthly survival number is the crucial first step in calculating exactly how much financial protection your independence requires. The standard financial recommendation is to maintain an emergency fund capable of covering 3 to 6 months of these essential expenses. For the average single person, that suggests a daunting cash reserve of $14,000 to $30,000. This is a significant, long-term objective that most savers can only achieve in small, steady increments over the course of several years. This is why many financial experts suggest starting with a smaller goal, the starter emergency fund. This is an initial reserve of $500 to $1,000. Reaching this $1,000 mark provides immediate protection. It ensures a common car repair or medical bill is paid in cash, preventing a minor expense from turning into a multi-year debt cycle. Where you store this money is as important as the amount itself. Keeping emergency funds in a primary checking account creates the risk of accidental spending, as reserves mix with daily grocery and utility money. Standard savings accounts at brick-and-mortar banks offer separation, but they currently pay a national average yield of only 0.41%. The practical solution is a high-yield savings account, or HYSA, typically offered by online-first institutions. While traditional accounts stagnate at 0.41%, top online high-yield accounts currently offer between 4.00 and 4.50% annual percentage yield. Online banks provide these higher rates because they do not have the massive overhead of physical branches and regional offices. However, many people wonder if money stored in a digital-only bank is truly secure during an economic downturn. Legitimate online high-yield savings accounts carry the same federal protection as traditional neighborhood banks. The FDIC guarantees your deposits up to $250,000 per depositor per bank. These accounts also provide a protective delay. It typically takes 1 to 3 business days to transfer funds back to your checking account, which prevents impulsive spending while keeping the money accessible for real emergencies. This combination of yield, safety, and intentional friction creates a psychological vault, shielding your savings from both inflation and the temptation to spend it. We return to the kitchen table. An unexpected $800 repair bill has arrived in the mail. For a single woman with a funded high-yield savings account, the stress of this arrival is neutralized. The money is already there, waiting in the vault. The transfer is initiated, and the bill is paid in full. The emergency fund has downgraded a potential crisis into a mere logistical inconvenience. Maintaining this reserve preserves the autonomy you have built in your daily life. It provides financial breathing room, the power to face life's unexpected moments with logic and calm rather than panic.